Good day, students. You are welcome to LODS lecture series. I'll be taking you through a quick tour on ACT 314 Intermediate Accounting 2. This video is for Station 5 Stockholders Equity. Do enjoy your learning as you go through this video. Introduction. This study session will provide an overview of stockholders' equity. Whether you invest in a company now or you intend to invest in the future, you are likely to come across stockholders' equity at some point in time. A stock is also a share in ownership of a company. Stock represents a claim on the company assets and earnings. As stocks are acquired more, ownership stake in the company becomes greater. In stockholders' equity, shares are also important features. Shares is a financial part or portion of a corporation which a stockholder can acquire in stock. Shares can be authorized. Whether you invest in a company now or you intend to invest in the future, you are likely to come across stockholders' equity at some point in time. In this study session, you shall be introduced to stockholders' equity and its contents such as corporation, stock, paid-in capital, and shares. Stock is a share in the ownership of a company. Stock represents a claim on the company's assets and earnings. As stocks are acquired more, ownership stake in the company becomes greater. In stockholders' equity, shares are also important features. Shares is a financial part or portion of a corporation which a stockholder can acquire in stock. Shares can be authorized, outstanding, or issued. Outline of study session 4. When you have studied this session, you should be able to explain the concept of stockholders' equity. You should be able to define and explain corporation, and you should be able to describe and explain financial stock, and you're able to explain financial shares, and lastly, you're able to explain paid-in capital or contributed capital. Concept of stockholders' equity. Stockholders' equity is the residual amount of funds in a business that belongs to the owner of the entity. The amount of stockholders' equity can be calculated in a number of ways. The simplest approach is to look for the stockholders' equity subtotal in the bottom half of a company balance sheet or statement of affairs. This document already aggregates the required information. If a balance sheet is not available, summarize the total amount of all assets and subtract the total amount of all liabilities. The net result of this simple formula is stockholders' equity. If the preceding options are not available, it will be necessary to compile the amount from individual accounts in the company general ledger. If so, the stockholders' equity formula is you add the common stock with the preferred stock with the additional paid-in capital, then with retained earnings, or you can less retained earnings depending on the retained earnings. Then you add the treasury stock, makes up the stockholders' equity. Example 1 and solution. Monica is staring at her computer screen and found M&O Corporation statement of financial position. Her screen shows assets and liability. Asset of 16 million naira, liability of 3 million naira. The question now says, what is stockholders' equity? Solution. Stockholders' equity, as described above, is the difference between the assets and liability. When you deduct liability from assets, you get the stockholders' equity. From this simple example, we found out that the asset is 16 million naira less the 3 million naira of liabilities give us 13 million naira as stockholders' equity. Corporation. Corporation is one of the most common form of business organization and one which is chartered by a state and giving many legal rights as an entity separate from its owners. The form of business is characterized by the limited liability of its owners, the issuance of shares of easily transferable stock, and existence as a going concern operation. The process of becoming a corporation is called incorporation, and this gives the company separate legal standing from its owner and protect those owners from being personally liable in the event that the company is sued, a condition known as limited liability. Incorporation also provides companies with a more flexible way to manage their ownership structure. In addition, there are different tax implications for corporations, although this can be both advantageous and disadvantageous. In this respect, corporations differ from sole proprietorship and limited partnerships. Various examples of corporation include Nigerian National Petroleum Corporation, Nigerian Railway Corporation, and Nigerian Film Corporation. Advantages and disadvantages of a corporation. Advantages of a corporation include 1. Limited liability for the owners. 2. The ease in which the owner can sell their ownership interest. And 3. Continuity. Lastly, we have ease in raising money. Then disadvantages of corporation include 1. The complexity of starting and running a corporation are said to be a disadvantage. To incorporate, an application must be filed with and approved by one of the 36 states. And once approved, the corporation must comply with that state's regulations. In contrast, a sole proprietorship can be started in minutes, sometimes with nothing more than a tax identification number from the state. Many of the legal requirements imposed on a corporation do not apply to sole proprietorship. Another disadvantage associated with a corporation is the possibility of double taxation on dividend it pays. Financial stock. Stock represents a claim on the company assets and earnings. As you acquire more stock, your ownership stake in the company becomes greater. Whether you say shares, equity, or stock, it all means the same thing. Stock is the evidence of ownership interest. It is not a loan to the corporation. Stock does not come due or mature. When an investor gives a corporation money in return for part ownership, the corporation issues a certificate of ownership interest to the stockholder. This certificate is known as a stock certificate. The financial stock are divided into two. We have common stock and we have preferred stock as shown in the slide above. Common stock. Common stock is well common. When people talk about stocks, they are usually referring to this type of stock. Then we have preferred stock. Preferred stock represents some degree of ownership in a company, but usually does not come under or with the same voting rights. This may depend on the company. With preferred shares, investors are usually granted a fixed dividend forever. Financial shares. Shares are the marketable instruments issued by the companies in order to raise the required capital. Shares are issued by each and every company which goes public. These are very popular investments which are traded every day in the stock market. And the value of the shares at the end of the day decides the value of the firm. Some investors may have large ownership interest in a given corporation, while others own a very small part. To keep track of each investor's ownership interest, corporations use a unit of measurement referred to as share or share of stock. The number of shares that an investor is printed on the investor stock certificate. This information is also noted in the corporation secretary record. It is connected to the corporation accounting records. The ratio of investors to stock owned is different for every corporation, and it will change many times per day depending on who is selling or buying the stock. Let's say, for instance, if an investor owns 1,000 shares and the corporation has issued and has outstanding a total of 100,000 shares, the investor is said to have a 1% ownership interest in the corporation. The other owners have the combined remaining 99% ownership interest. Authorized shares. When a business applies for incorporation to a Secretary of State, its approved application will specify the classes of stock. the par value of the stock, and the number of shares it is authorized to issue. When its article of incorporation are prepared, a business will often request authorization to issue a large number of shares than what is immediately needed. Issued shares. When a corporation sells some of the authorized shares, the shares are described as issued. The number of issued shares is often considerably less than the number of authorized shares. Corporations issued or sell shares of stock to obtain cash from investors, to acquire another company, to acquire certain assets or services, and as an incentive or reward for key officers of the corporation. The par value. The par value of a share of stock is sometimes defined as the legal capital of a corporation. The par value of common stock is usually a very small, insignificant amount that was required by state laws many years ago. Because of those existing laws, whenever a share of stock is issued, the par value is recorded in a separate stockholder equity account in the general ledger. Any proceeds that exceed the par value are credited to another stockholders equity account. This required accounting means that you can determine the number of issued shares by dividing the balance in the par value account by the par value per share. Outstanding shares. If a share of stock has been issued and has not been reacquired by the corporation, it is said to be outstanding. For example, if a corporation initially sells 2,000 shares of its stock to investors, and if the corporation did not reacquire any of this stock, the corporation is said to have 2,000 shares of stock outstanding. The number of outstanding shares is always less than or equals to the number of issued shares. Then the number of issued shares is always less than or equals to the authorized number of shares. Relation between outstanding, issued, and authorized shares. Number of outstanding shares is less than or equals to the number of issued shares, which is less than or equals to the number of authorized shares. When a corporation reacquires shares of its own stock and does not retire them, this corporation is said to have treasury stock. The number of outstanding shares is equal to the number of issued shares minus the number of treasury shares. Paid-in capital or contributed capital. Paid-in capital represents the funds raised by the business from the equity and not from the ongoing operation. Paid-in capital is a common balance sheet entry listed under stockholders' equity, often shown along the balance sheet entry for additional paid-in capital. It may also be referred to as contributed capital. Then we have capital stock. Capital stock is a term that encompasses both common stock and preferred stock. Paid-in capital or contributed capital is that section of the stockholders' equity that represents the amount a corporation received when it issued its share of stock. Example 2. A corporation common stock has a par value of 0.10 naira per share. On March 10, 2013, one share of stock is issued for 13 naira. This 13 naira represents the fair market value based on supply and demand for the stock. Make journal entry for this transaction. If you look at the question above, you discover that the accountant that want to make a journal entry will record the issuance of one share of stock along with the corporation receipt of money, and you must note that the common stock account reflects the par value of 0.1 naira per share. Then if you look at the solution, you discover that you have to debit the cash account with 13 naira, which is the fair market value of shares, and you credit the common stock and paid-in capital in excess of fair value. The paid-in capital in excess of fair value has to be the difference between the fair market value and the stock par value. That is 13 naira minus 0.1 gives 12.9 as paid in capital in excess of pay value. And the common stock of 0.10 naira per share has to be credited too. We have come to the end of this study session. Hope to see you next class for study session 6. Thank you for listening. Bye.